Alrighty. Uh, Ajit, thank you very much for taking the time out today. Rakesh told me about your schedule and the travel plans that you have because of the NFO, but this is something that I thought we would do for our audience, especially because of everything else that you are planning to do, not just from a NFO launch perspective, but in terms of having having giving so much of priority for this concept of retirement and the importance that this deserves with the insights that you are PGIM Global is trying to do in terms of having people lead like what I like to call liberated lives around money, right? So what we're going to do today, Ajit, the purpose of this call is to understand your NFO a little better. Why retirement
Sure.
right now? Because given the fact that there are hardly few players who've got an allocation to this particular segment,
Yeah.
why specifically a retirement fund when we could do so many other things?
Sure.
And secondly, in terms of you all came up with a very nice retirement gigs post renew and renew but not retire. I think
Yeah.
that was beautiful. I'd like to know exactly how did that come about, why,
Sure.
and then we'll talk a little about the fund performance, and then we'll take it from there. So
For sure. Sure.
all over to you, Ajit.
Yeah,
Let's
thank you
take
so
this.
much for having me here. And this is a subject, as you know, and most of the people who know me know it's been a passion for me for many years now to dive into the subject because in India we don't have the kind of social security systems that we see in the Western world, and so it was intriguing to say that how can we as a community help people understand the subject better and be prepared for it better. So much of what we
Right.
do is in that, and I'm sure that in our conversation we'll hit on many of these insights as well.
Sure. Awesome. So do you want to begin sharing the screen
Uh,
and
Yeah, so I'm not going to be doing any sort of presentation because it's lovely to sort of speak about it. So Shagat, I think when we start off on the subject of retirement, I think one aspect is that we sort of decided to be the only AMC actually here doing retirement readiness research in India. We did a report in 2019, which we published in
hmm,
2020, the beginning of the pandemic, and then we did another one at the end of 22 and published it in 23, so we could see the shifts of how people think in India about their retirement readiness. But more
right.
important than that is really the many conversations that we had with people, which gave us some very solid insights about why people deal with this subject in the way that they deal with. And
Hmm.
to keep things short, I'd say that the most important insight we have is that people only invest for happy goals. That's the big insight. People only invest for happy goals. So, children's education, their marriage, buying a house, buying a car, starting a business, going on a vacation. If you think
Hmm.
about the goals that people put money aside for, in their head, there's a happy picture associated with that particular goal. And
Right.
that's where the difference with retirement as a goal comes in. It's not a happy picture for most people, right?
Hmm.
In your mind, when you think about retirement, for a lot of people in service, may not be for so many professionals who love and are passionate about their profession. But for a lot of people, probably in services, they're thinking of that uncle or their neighbor who's got diabetes and hypertension, and is basically no longer as respected as he was in his workplace, and so therefore he's pretty much going downhill in various respects according to people, and they don't want that for themselves. And
Right.
that's just not a happy picture. So the insight we also have is that even in a conversation with investors, even the word retirement shuts their brain down to having a negative emotion associated with it. So they just don't know how to grapple with it. And I think we believe that that's one of the reasons why people always push retirement as an investment priority down the list. So they will
Hmm.
always start with children's education and spouse's security and the house and whatever else. And then on the fifth or the sixth or the seventh position is when you get retired. Our own research in 19 said that retirement was the eighth priority for people. And in 2022, we saw that it had moved up to the sixth position, but it's still the sixth position. So
Right.
that's one very important aspect. And I think it's important for people to reframe this subject in their mind to be a happy one that they're looking forward to. Even maybe drop the word retirement and use financial freedom as the goal that they're planning for. Everybody
Hmm.
wants financial freedom. So I think this is a nuanced aspect of it, but I think it's a pretty important aspect of what we are getting to see in this space.
Got it. So help me understand, Ajit. I obviously with the limited families that I work with, um, I tell them that retirement is the only goal that does, or only expense that you don't get a loan for, right?
Sure.
You get a loan for everything else, but you don't get a loan for retirement.
Right.
Now, the idea being, uh, for most people, when they're planning for retirement, it's like, okay, you know what? I have so much of time available. And, it's just going to be another 15, 20 years. But uh, in my book that I'm writing, I'm also writing about why retirement has three different kinds of risk, right? One is living too long. One is not knowing whether you will have that much time to work because given everything that is happening in the world today. And last but not the least, how are you going to be surviving through retirement? What if there's a health condition? So, with the research that you all are doing, how are those insights or facts playing out?
Most people in India, at least in what we are finding in our surveys, seem to still prefer guaranteed products.
Mm,
Put money in FDs. More than 50 or 55% of the people would have put money in FD or postal savings or then insurance products, which are related to insurance. I mean, which are related to retirement. So that seems to be the predominant way that people approach retirement savings. And we did see, however, that in 2022, 23, that, the aspect of mutual funds sort of started growing from a 10% of the audience to about 24% of the audience. Even a
mm,
PPF and NPS kind of product has sort of moved up because awareness has grown.
right.
Interestingly, the sense of confidence for retirement readiness was higher with people who had invested in things like mutual funds rather
Mm,
than in fixed products, right?
okay.
That is one. And I think that while we are at this subject, it's important to say that in our survey, when more and more people were telling us that after the pandemic, that they felt that they were more retirement ready. From 49% in the previous survey who said they felt retirement ready, the number had jumped to 67% people saying they felt retirement ready
Wow.
post-COVID. And when we dug deeper, we found that 75% of those people had actually put money into insurance and thought that, okay, we've done something, we've taken an insurance, or maybe it's an annuity product or whatever it is that they put it for, and they
Mhm.
felt retirement ready. So it's very important to see that people's perceptions of what they should be looking at from a longer term perspective. Like you said, what if they live longer? What if they have a health condition? I think those are important things that people are still not baking into their
Understood.
decisions for investment at whatever
Right.
stage that they might be. I
Right.
want to add, however, that globally, when you look at retirement research, there's another important aspect I think that people need to keep in mind, and which is that sensitivity to volatility in a portfolio keeps rising with your age. So what
Mm,
it means is that the longer you delay thinking about the right ways to sort of allocate your money towards this very important goal, the
mhm,
more you're going to be sensitive to returns in your portfolio, and you're likely to start taking higher risks about wanting to make up for your corpus faster and then jump into high return products and then see the volatility jump out, jump in again, and ruin the sort of sequence of returns required. And that happens because most people put off saving for retirement later on in life to their
mm,
40s and early 50s. Our research and survey also tells us the same thing. If some of them have done it in their 35s or so, if they haven't, most people say we will start in our 50s. What they don't
mm,
realize is that human beings will, react as age progresses to volatility and risk differently. And so
right.
it is so much more beneficial to start looking at how to take those decisions much earlier, rather than leave yourself open to, risk of that volatility and the sensitivity to that volatility really as age passes.
So what I hear you saying is, Ajit, that what you've observed, and quite frankly, I think this is exactly what happens when most of the families come to when I take them on board because they're usually in the mid 40s, early
Yeah.
40s, because at that point in time you're not quite sure, how many more years you're going to be working. You've seen a friend lose a job, you've seen a
Mhm.
friend being asked to leave or change of career, or a certain situations just happen. Kids are, the higher education for the kids are happening, you have probably what 7, 10 years, and are you even ready now? For
Right.
some people, fortunately, because there has been a good amount of deduction in their employee provident
Yes.
fund, there's at least some large amount of corpus. But what we don't realize is that entire money is locked for the long term. It's not something that you can fall back on in case there's a loss of job. And most people, up the corporate ladder are not finding a replacement job quite easy. I've had a situation where I think about 6 or 7 of them have lost their jobs, and it's been 6 months with over 25 years of experience. They have not been finding a job or replacement just as yet. So the way I see this is there is no plan B set up just as yet. And while you're over doing this retirement gigs, interestingly, the 50 different things that you can do prior or during retirement or after retirement is, I found that to be very interesting because you all have made it very easy. It's not particularly to your career, what you've been doing all along, but if there's an interest that you liked, these are things that you could also go planning for. And what I liked about it is need not have to happen at the stage of retirement, right? I mean, retirement could be from things that we do not probably like doing right now.
Right.
Hey, but if I like doing, let's say if I was just coaching, right? I could coach probably till I'm 70, as long as I can know how to use the internet and probably use my laptop and I can speak. I think I can be employed, or rather I'd like to do work till the time I can. So what led to this work that you'll have done in terms of, from what I remember, renew, recharge, but never retire? So I'd like to know what led to that work.
So Sharad, it really came from our research and survey, retirement readiness surveys that we did. What we saw in the 2019 and the survey that we did then, and then what we saw also in 2022, is that the people who seemed to say that they felt the most confident and ready for retirement were people who had an income from a secondary skill. So when we looked for it and said, okay, what gives you confidence and what is your confidence level that you're not so anxious about your later years in your retirement, people who said that we have a secondary skill from which we get an income were the ones who were the most confident. And there were 36% of those people who said it. There were 39%. Beyond the 36%, there were 39% of people who were saying to us that I don't have a secondary skill right now from which I earn an income, but I definitely plan on having a secondary skill from which I'll get an income. Only 25% of people said, I don't think I'm going to have one, or I don't have one now, either ways. And mind you, this is not secondary income coming from an investment portfolio, because that's also a secondary income. I mean, whatever you have invested, when you're getting an income out of it, that's an income. But this was a unique skill from which they were getting a secondary income. These are the people who are most confident. And frankly, Sharad, this sort of tied in with something that we felt on the subject of retirement, which is that your biggest risk when you think about retirement is not about the corpus or the money that you will probably need or have. It is really that you run a concentration risk of earning from just one skill. You're just a one-trick pony, if I may say so, in a sense of the word. So the most resilience that you can build for yourself through your longer years, and when I say resilience for your longer years, it's especially when you feel anxious that maybe I won't have the monies that I need for how long I live. Maybe I'm going to be dependent on my kids. And I fear all of these things. And I don't want to be dependent on my kids. I don't know what I'll do longer. And if you want to solve for that, I think you need to be thinking about what you love, what you enjoy, and can you make some money out of it, right?
That's right.
And that's the trick. It's not just doing what you love or enjoy. Can you monetize it? And we are also not saying that you need to monetize it in some big startup way, right? Trying to say is maybe you were working in a tech company and you had a 5 lakh salary. The last salary that you were drawing is 5 lakhs. Our question to you is, can you earn 25,000 bucks a month? Or doing maybe teaching in a college, or maybe you love fitness and you want to take a certification and become a Reebok fitness trainer. Maybe you love fitness and you want to open up a grooming, a business or a pet sitting business, somewhere. Think about it. I mean, the options that we've put together in the 50 gigs are quite a lot, and we intend to expand it as well. Maybe you have a good voice and you want to, use your voice for animated movies and put yourself out there and train yourself for it. Maybe you can be an executive coach and do a certification for that. Maybe you know a couple of languages and you want to be a translator for it. So the if when you go out there and start actively looking for it, you realize that you have a lot of things that you loved while in college or otherwise, and there's probably a way to earn 15, 20, 30,000 bucks out of it a month. I mean, it doesn't
Right.
matter. You got to monetize it. That's the key.
So the idea being now, if we've taken care of pretty much most of the, landmark goals, like we were talking about child's or children's education, vacation, I think there will be a time, the way I see it, most people, instead of those, you know, cruise or that one large vacation, when compared to, hey, you know what, let me bring that down a little. I can probably focus on, like you mentioned, like, start up an academy, or, the plan B basis. You at least see what are the other, where we can go about putting this money to better use, where that, hey, it's not necessarily that one vacation or that one time, when compared to, putting this money across different stages. And probably, you never know, you might be able to retire from your corporate job, or not the work that you're doing, which may not be of that interest, when compared to, probably working for a lesser pay, but at least doing what you love to do, as against having to do what you're forced to do.
Yeah, and I think, Sharath, also when people think about it in the way that we tend to say this, that, yeah, sure, you should just hang up your boots and do what you really love to do. I think where people hesitate is that if you're used to a certain lifestyle, you don't want to reduce it. And the picture in your mind is, well, if I do all of this, will I be able to do all of the things that I did, given that I had this corporate career and the guarantee of the income and the confidence of doing the things that I want. So I do think that it's important for people to realize that when we think about investing, when we think about money, one aspect which is very central and tied into all of this is lifestyle. And it's lifestyle that you are actually trying to protect. You don't, like in the Western world, you'll see people upping their lifestyle into retirement. In India, you tend to probably see more examples of people dropping their lifestyle into retirement, saying, okay, maybe do this. And then you realize that, oh, maybe instead of a big city, I can move to a smaller city so my expenses would be lower. Nothing wrong with that. That's a great strategy in itself. A lot of people do it. But I think that when we think about hanging up your boots and how you can probably continue to live your lifestyle and things like that, sure, there has to be adjustments that you will make based on your personal situation. It's not a one size fits all. But I think that it's important to realize a dimension of this longer years that you have, which is physical health, right? And that physical health is very, very closely tied to mental health. And what you really are telling yourself is, if you love your corporate job, why the hell should you hang up your boots early?
Absolutely.
But there's going to be a high probability that you hate your boss, and you don't really like to see the people's faces every morning, and you wish that you had something else to do. You're looking forward to the day that you can just call it quits and things like that, right? And I think that is that will definitely impact stress, mental level stress, and therefore reflect in your physical level stress. And then it's a one-way down when you're thinking about longevity and things like that. As you don't want to live your older years with some health condition, just like you mentioned. So the key when we talk to people about saying, don't worry about, hanging up your boots, even if it's earlier, there is a very strong dimension here. That dimension is that if you're doing something you love, your mental health will reflect on your physical health. You are going to, staying active and purposeful is more important than the amount of money in the bank. And as advisors and us in the financial industry, if you have a trusted advisor and you look at the math of it, we can show you how the math can work to keep your lifestyle going. That's the gig income can come in place. But, I will stop by saying that the investment connection to all of this is thinking that you will need to get out of equity or reduce equity into your later years. I think you've got to change that mindset to say you need equity into your later years as much as you need it in your early years. In fact, you would know about target date funds. This is the most famous product for retirees all over the world, globally. And there is research to suggest that target date funds don't really, cut it,
Mm,
because you are putting equity at the front and it'll slowly move to debt or fixed income towards the end of the target date maturity.
mm.
And what you're actually seeing here is that, you are actually giving equity when people's saving capacities are lower, and you're adding debt to the point when the people's saving capacities are higher. They
Absolutely.
don't end up giving you the sort of outcomes you want to. So let me stop there and pass it back to you.
You know, you in fact mentioned so many points that I think I should have begun making notes to, make it easier for our audience. So, long and short of what we spoke from the retirement gigs, there are two aspects here. One, retirement is not necessarily age, right? It's a stage when you realize, hey, I can also go about doing income from or earning an income from other alternatives that I can do. That could be A, B, C, D, whatever it is. And sooner we plan for it, the better it is. And it need not happen just from one instrument, right?
Yeah.
And obviously, sooner we do it, the better it is as compared to taking it all the way till, 50, 55, and then have this conversation and say, hey, you know what, is it too late or whatever it is? So that's one point. But we also spoke about target date. And I think, Ajit, this would be quite helpful because that was bringing me to my next question. I have a lot of people, obviously, before this gets started, they have a significant amount of money in PPF, they have significant amount of NPS. NPS is still okay, but obviously it's a different product used for different reasons. But PPF, right? Now, one thing that I tell my audience, one thing which is guaranteed that you can be absolutely assured of with the government products is two things. One, it's a bloody long lock-in period. Two, the interest rates will keep coming down. Starts off with a non-taxable benefit and eventually ends up getting taxed. Today, I think the only product that is non-taxable is the PPF, right? And it's history is proof of it. Whenever the governments don't know how to manage money, taxes become the easiest solution to it, right? So with that said, now, because you mentioned the target date, let's get to the target date in just a bit. But from a PPF, because we have seen tons and tons of example where you compare a PPF, even though if it's safe, gives you guaranteed returns, non-taxable, when compared to investing in a mutual fund or let's say equity markets where you're getting 12 to 15%. What kind of differentiation in corpus are we talking about? I mean, what are your thoughts about that? Because again, this is fixed income, and then people talk about the diversification angle of it, right? You don't
Correct.
need to put all of your money in one place, and it was better that you have your money being more structured, protected, and things of that sort. So I'd like to hear your thoughts about, at least from a research standpoint, and because you'll have advantage of things that have happened, you'll have this foresight of what has happened in the Western world, how that has panned out when
Yeah.
compared to, and I think India is just about 20, 25 years behind the Western world when it can, obviously, with looking at everything that's panning out for India, I think more or less we'll pretty much face the same kind of situation that the Western audience has faced. But I'd like to hear from your
Yeah.
basis the research you'll have had.
Yeah, sure. I mean, just looking at the data on this, Sharath, if you look at the total retirement corpus globally, if you put all the
Mm,
products together, I think it's roughly about $56 trillion into retirement products. But when you look at it at a country level, I would say that in India, we probably have 17% to GDP when it comes to retirement products. And the corpuses that have been built globally in the developed
mm.
markets, it would be 100% of GDP. So, we
Wow.
have a long gap with what we are trying to put into retirement corpuses and building retirement corpuses.
And this is also because of the fact, I think the 17% is because there is forced saving that you have to
There
do
is
into
there
the
is forced
EPF.
saving for service class, and it's a smaller percentage of the total workforce in India, right? There's more
Mm,
unorganized in labor. So imagine the difficulty for those people who don't have the forced saving. So the Western world since the 80s have had the what's called the 401k plan for retirement.
mm,
It's the
mm.
tax section 401k, where if you're working and you put money aside into a 401k plan, you can decide when you will withdraw it. You can let it extend
Right.
it for a longer period, which will give you better benefits and things like that. And we don't have those kind of social security systems in India, but we have the NPS, which has started. Of course, the NPS has its advantages that when you switch between plans, there is no capital gains at this
Mm,
point of time. That's a benefit.
right.
It's the lowest cost retirement product out there. That's a benefit. Third, you will get 60% of the money back tax free, but 40% of the money will need to be used to buy an annuity for
Right.
life. So that's considered by some people as a disadvantage, but why buy that annuity? The PPF at 7.1% guaranteed, and you've locked in the money. I mean, or you're going to get it over a period of time. You have very few conditions on which you can withdraw from it. I do believe that post-COVID withdrawals have risen because people have had
Obviously,
hard times, so you withdraw
obviously.
to the extent that you can and things like that. Then you have senior citizens plan for the regular folk, and you can invest into that. That's got a great rate of return as well. You've got insurance products, of course, and then you've got mutual funds. So you've got this whole sort of menu
Gamut.
of products that you can use for your retirement. And I think the right answer is that not there is no single product amongst all of this that ticks all the boxes. And therefore, in some sense, you need to simply have a trusted advisor to tell you what's the combination of this that works for me based on where you are as far as your age is concerned and things like that. And the reason I say that there is no single product that will check all the boxes, again, going to fundamental research around retirement, there are two aspects that one needs to consider. One is something called the sequence of return. And the sequence of return simply means that if you have had a conversation with an advisor that says, here I am, this is the money I have, this is the money I'm likely to earn on a regular basis that I can put aside, here's what I need for my retirement. And, you sit together with the advisor and calculate, okay, with this kind of money that you have on a regular basis and already the lump sums that you have, you likely need a 12% compounding for your asset and you'll get to your goal, right? And so therefore now you need a sequence of returns for that time period, whether it's 7 years or 10 or 15 or 20, whatever your retirement would be, to get that 12%. And you need lower volatility around that 12%. You don't need too much of volatility up and down. You'll never get the 12%. You need lower volatility. And that's what any advisor would do. Build a portfolio that fits that 12% kind of average return. You need to look at that sequence of return. And if you know what that return is broadly that you require and the sequence of return you require, that's what will be an important input into deciding whether you will have more money in PPF or lesser, right? More money towards mutual funds or lesser, on whether you need a much higher medical insurance, just so that if you think both genetically and otherwise that you might be headed towards medical issues, you're covered for that expense, and that does not destroy the capital that you're building towards it. So this is one technical aspect, the sequence of return risk, so as to say, which a good advisor always helps people to sort out by combining what you have. Your second very important dimension to this question, Sharath, is the person himself or herself. They're a human being. They have emotions. They may have a disabled child at home. They may have parents who have a medical condition, or the spouse might be somebody who is extremely smart with a lot of things, but not with finance. And so you worry that if I took all my money and put it into this great, beautiful mutual fund product that seems to give the best market-linked return, what happens if I die? And what if my relatives come after the money that is actually meant for my spouse? Because it's all sitting in open-ended funds. I'd rather lock up the money and make sure she gets a steady stream of funds so that we can touch that money should something happen to me. So for that person who has that fear, an annuity is a great product, right? For somebody who thinks that they have children and they want to protect them or themselves, they have parents whom they also need to be taking care of, the guarantee of the PPF return at 7.1% is great. If they think interest rates are only going to go lower and lower and lower into the future and they're saving this money, PPF works fine as well. And there are certain design advantages for your behavior. The design advantage of a PPF is you can't touch it till you're retired. So you go around saying, I think I need some money for, this great model of car that I like, and let me just break my investment, which I'd kept for my retirement in my mutual fund, to buy the car. You can't touch your PPF. So if you believe genuinely that I'm not good with money decisions because I can tend to be emotional about what I want. Lock up your money, some part of your money. And I'm not saying all your money, right? Some. And that's where the design of a PPF or the design of an annuity actually helps. Mutual funds are open-ended. You can get in and get out any day. And therefore, you will be very subject to your
Not just that,
emotions.
I think the bigger challenge is you can track it every day, which is a
You
bigger
can track it.
problem.
You can. And sometimes that's the problem. Yeah, exactly. That's the
Absolutely.
problem. You're tracking it and you
Absolutely.
say, oh, I think I got a great return last year. So I think I can pull some money out and do this. And by the way,
Precisely.
you're right. Right. That's the advantage of mutual funds. So while mutual funds have this disadvantage that it's open-ended and that you might end up not being very disciplined about it, I think the potential to create wealth through mutual funds, if you have a long time frame with you, is that it allows you in a much better way to increase your lifestyle, right?
Right.
You get those little bonuses every 4 or 5 years where your returns might be good compared to your sequence of return. And therefore, you can take a little bit of money out and go fly business class this time rather than, and do it, enjoy life. I mean, what's the point of all of this money if you're not enjoying life with your money? And mutual funds, the proportion of mutual funds that's good for you will help you do that. Instead,
Sure.
what people tend to think is, oh, it's market linked. And, so what I should do is what I've heard from my parents and what I've heard from my neighbors and else is as you get closer and closer to retirement, just put all your money in a fixed deposit or a postal savings scheme or insurance. That's where you end up compromising on your lifestyle because you're
Right.
not getting the return profile you want. It has some
Right.
advantages, but then it has its disadvantages from a lifestyle perspective. So long answer, but it's very nuanced when you think about who you're talking to. Each
Right.
individual may have a different need, really.
Understood. So, what we will, or rather, what you're trying to say here is, Ajit, instead of randomly just looking at numbers, because obviously, if you look at a 7% tax-free vis-a-vis a 12% or a 15 or an 18% deferred taxation,
No
the
content.
answer is obviously it's very obvious, but it is very dependent, and hence an investor should not go about just taking a decision because this is what they feel, believe, or think, right?
Yeah.
What is important is you need to figure out what your needs are and how your habits around money is. If you are one of those people who goes window shopping and you're going to be coming out with some purchase, then might as well lock the money, even if it comes at least the capital is there. But if you're the kind of person who says, hey, I've got good control over my money, I'm not going to get very emotional, and
Yeah.
then I go about putting my money in for the long term.
Yeah.
So with that said, now, Ajit, that brings me to my next question in terms of why now, because this is going to be the obvious question. Although we invest for the long term, timing of the market seems to be a very, very hot question. I mean, this is something that I've had over the last couple of weeks as well. Now, is this a good time? Should we wait for elections? So, one, retirement product has a 5-year lock-in. Two, you're coming at a stage where where we are at the moment, because I think it's going to be one of the biggest businesses that the country is going to be getting into. So I'd like to hear from you on that one, Ajit.
Yeah, I think there are a couple of points here. One is, one of the things that research suggests is that we like to mentally bucket things, sort of put things
Mm,
into a bucket so that we can better manage our emotions and better manage our discipline around what that money is for. So one of the reasons why now with a retirement fund or a fund called retirement, I mean, the big question is,
mhm.
if you're investing in equities and it's a diversified portfolio, why do you need a retirement fund with a 5-year lock-in to do?
Correct,
You can do
correct.
that in a flexi cap or a balanced advantage or a hybrid and whatever. The research-driven reason for it is that if you put money into a pot called the retirement fund, you're likely to anchor yourself to a discipline meant for that goal much better than putting money for your retirement in a flexi cap fund and forgetting that for your retirement 3 years later when you want to head out to buy, your Harley Davidson, and then you realize, okay, I'm going to break that, and you end up, sort of touching it. And
Mm,
here you've got, even the 5-year lock-in sort of allows you to see that, all the data seems to suggest that the the number of negative returns that you might get on a portfolio significantly reduces if you have a term of 5 years and above. It's like maybe 1% or less that you might end up with some, losing a little bit of capital if you're a 5 year. And it's much higher. It's 30 to 40% higher, chances if you were looking at it over a 3 year or 2 year or a 1 year time frame. So as you give it time frame, the negative return incidences on your portfolio tends to reduce. And we haven't seen any negative incidences for 7 years and 10 years rolling data that we look at for the market. So that 5 year lock-in sort of serves that sort of purpose. The name of the fund serves the mental accounting bucket theory that, it helps you commit yourself to something that you do. And I think the third aspect is that we're looking for a structure which is unique within the retirement funds available in India, which is that we're looking for a multi-cap kind of structure to be followed within our retirement fund. What
Interesting.
I mean by that is that the regulator in India, SEBI, defines a multi-cap product to be something where you need to have a minimum 25% in large cap, a minimum 25 in mid cap, and a minimum 25 in small cap. And the balance 25 can be adjusted in whichever market cap you want. Now, what again I feel is design. The behavioral aspect of it. If you're saving for retirement and you're a young person or a middle-aged person and you have time on your side, which is 5, 7, or 10 years more, then you want the fund manager to have a minimum allocation to small caps in India, mid caps in India, and large cap. If you looked at the structure of a typical diversified fund, which is a great product, a flexi cap or whatever it is, you'll find that fund managers who tend to have a large cap allocation and then play around with a little bit of the mid and small cap. But here you know that you're going to get a minimum small, a minimum mid, and a minimum large. So it's a predictable sort of structure. And I think that at PGIM, we have oftentimes tried to bring more predictability into the strategy that we will follow, communicate that so people understand what are we trying to do. So that's like the sort of third aspect. The last one, which is the key question around the valuation and where do we see markets and things like that. And I don't follow markets because I myself use a financial advisor. I've been doing that for the last 14 years. I'm good at all my goals for my daughter, my son, and our retirement and things like that. I've never bought an equity stock in my life. Actually, I bought one. My brother's company was going for IPO, and I wanted to help tell him that okay, I'm going to put some money in this company that you're with. It's a large public company, and of course, I withdrew that after about 5 or 6 years. But that was the only stock that I actually bought. So I have stocks in my life, and I've used an advisor, so for all of my financial goals. But I think the real answer to your question around valuations is something else, which is the PGIM philosophy and the PGIM style for managing our equity. And what we do is that we have a much larger bias. We definitely have a growth bias for our investing style. So it's a growth house. Okay, we're not a conventional value house. We are a growth house. We are also not a conventional momentum house. We're a growth house. We look for the valuations of companies that have long sustainable earnings and profit growth and go there. Now, there are many fund houses in India which are growth houses for sure, because India is a country meant for growth. So you've got to work on that. Within the growth houses, we are a little more biased towards quality in our stocks, which means that the companies that we choose into a universe of any of our funds should have a above average profile for return on equity and an above average profile for sales growth. It's a bias. So we want to have 50-60% of our portfolio with those kind of stocks. That's a little unique. There are few fund houses that are in and around our style of doing high quality growth. And Sharad, the point is that for the last 12 to 14 months, this segment of the market, the great quality growth companies have been smashed beyond recognition. And that's got to do with interest rates. And without being technical too much about it, after the Russia-Ukraine war, as interest rates rose all over the world, and it rose pretty rapidly in a very short time frame, what it did was for a lot of equity analysts to say that if interest rates are going up, then the profit possibilities of the companies which we have given the best stock prices to may not be able to keep to the same margin of profitability. So we need to reduce their prices. And so those stocks have come off. And people don't just take money off and keep it under their bed. You just rotate it from what's working and what's not working. So you take it out of the good quality stocks that have done well for some time, and then put it into whatever else is in the market, which may be lower. And so we've seen that, stocks around the value theme and the momentum themes have all done well over the last 1.5 years. Quality's out. What I'm trying to say, long story short, is that you've got gold at a discount right now, regardless of an election coming up and what's happening in the world. You've got good quality companies and portfolios that are built with good quality companies sitting at the bottom end of the performance chart. And I think it for us, when we are bringing out the retirement fund, we're going to follow the same philosophy of investing. I talked to you about the multi-cap structure and the benefits of that. I think we are getting into a great time of building the same portfolio of good quality companies which are available at a great price, so that for that sequence of return risk, for the longer term sort of return profile, we think that this would have the higher probability of being a great fund to have if you're looking to start saving for your retirement, or you want to shift some monies into your retirement bucket over the long term.
Interesting. So here's the thing, Ajit. I was a little hesitant when obviously I had a call with Rakesh. We went through the portfolio. We went through the changes that we're doing as a fund house. So my question, and obviously this is for my, the more I educate my audience, sometimes I get the most toughest questions from them, right? So the point is, in this segment of retirement funds across the mutual fund space, you've got about hardly, I think, 6 or 7 names at max. And the return profiles has not been as good as it would be when compared to the flexi cap or a standard fund. Again, obviously many of them have completed the minimum 5-year requirement period or whatever the story is.
Sure.
However, but whatever time that they've been existent for, when you compare them with a standard diversified fund, rather flexi or mid cap or whatever it is, the returns have not been as great, right? From a retirement fund. So what are you looking at doing at a fund house level to say that, okay, you know what, it's not going to be necessarily the same. We are going to be, while there's nothing unique, because obviously the regulator has clipped down a lot of options that you are planning to get to market. But if it's going to be a plain, simple, vanilla multi-cap fund with a 5-year lock-in, how is it going to be any different for the investors that way, or in that, at least in the rest of the retirement fund profile?
Yeah, so I think that this category, as you rightly said, it's got a few fund houses. It's not a large category in terms of total AUM.
That's right.
And many of the fund houses who have retirement products, they have multiple schemes for retirement that, under a single umbrella. So they'll have a full equity fund, they may have a hybrid option, and they'll have a conservative option that you can switch into over, your time frames and things like that. So therefore, if you looked at returns across the category, you will see funds which are called retirement, but have not very good profiles of return, because they could be the hybrid or the conservative option. Many a time, if you look at just the equity option, the pure equity option, it is also likely that you may have found instances where it's not as good as the flexi cap option or some other diversified option that you're saying.
Right.
I think that, the nuance in this is what point of time and period are you comparing a fund against the other? No fund manager likes to be compared to a whole industry where there's somebody doing better than him all the time, right? There's somebody at all points in time. What they would like to do as a fund manager is say, compare apples to apples. So I am a growth style manager and compare my retirement fund to other growth managers in their flexi cap and the others. And then I could probably have to justify myself as to why a growth style retirement fund is not doing as good as a growth style flexi cap fund in my own house. Because the fact is that if you compare it across fund houses, there could be various things. I could be following a diversified style in growth. Somebody could be following a concentrated style in growth. So there are those nuances.
Right.
But to justify yourself, I mean, the fact is that if you felt that you have great discipline with money, you could obviously invest in other products. As I said, the retirement fund has its own advantages for everybody. And I do think that when for us, when we think about how we want to manage this, it's clearly that while the style will be the same across our funds, the higher quality growth style, so to speak, we think that from a valuations perspective, the timing is good as well. And I think the third aspect might be a bit of a differentiator for us, which is that we're the only AMC that gives a lot of attention to retirement as a subject. And so in all the funds we have, even though this is a small category and it's a small fund, we are unlikely to ignore this little baby of ours, right? So it could be a small fund, and I don't think that we will not give it the attention that it deserves, because this subject is important to us, and it is going to be managed directly by the CIO. While most of the other funds are being managed by the other fund managers along with the CIO, here the CIOs will be the CIO will be the lead manager. Vinay Paharia will be the lead manager for the product. And I think that, I simply cannot forecast the future in terms of how we do. We're very confident of our style. We're very confident that over long periods of time, and when I say long, it's 10, 15, 20 years, not more. People's investment lives are 50 years and plus. But when we look at even the 10, 15, 20 years sort of timeframes, having that bias towards quality has clearly worked for a simple, commonsensical reason, which is that if by higher quality growth companies, we mean companies that have higher visibility of profits and earnings to the long term because they are in strong businesses, then their stock prices will surely follow. So it's more commonsensical, and we've seen this happen long term. There are times in between when a sudden spike in interest rate or some global tension can move things around. But I think that we've got to stick to our style. Think about the mistakes we're making at a portfolio level and work on that. Maybe we didn't get the sector right. Maybe we didn't get the allocation of the stock right. So we are not perfect there, but I think we're learning from all that experience that we have to say, okay, what more can we do to sort of tune the mistakes out and look at stock allocation sector, and that's a continuous process, of course.
Got it. So we did go about. You mentioned about the fact that Vinay is going to be managing this fund, and obviously, so what kind of size is this fund going to be? Because there was a point in time when PGIM, took over operations from erstwhile, the company that we were working with, and what was 100 crore AUM now today is, I'm talking about the mid cap, I'm talking about the flexi cap, right?
Yeah.
It is seeing that kind of growth. So what are you aspiring for the retirement funds, even though this is something that you all have not put in a lot of energies to market? And obviously the concept or the segment is more important. So I'd like to know, what is the vision or what's the aspiration for PGIM as a fund house for this particular segment?
Yeah. So, one of the aspects, Sharad, that we also have a very good sort of recognition for is in the international fund space. Even though RBI limits are currently constrained, and our funds are still open for investment, but there's constraints around RBI limits of investing. We're well known in the international fund space. We do only diversified global funds there, and we have a very unique global real estate fund as well, which a lot of people probably haven't looked at as well. And when we started this journey way back in 2019 or so, there were about 14 or 15 fund houses with international funds and AUMs. We were number 15, the last guy. Today we are number 6. And we are the top 6 in about 3 or 4 years. So when we look at a category and we like to be very evidence-driven and very solid what works for an investor. So in the international space, we felt that there are too many fragmented themes, EV, NASDAQ, China, Europe. And we felt customers are just putting 5 or 10 rupees out of their total investment into international. And what we should do is get a good quality diversified fund. Let the fund manager decide whether China is good or bad or Europe is good or bad. Let the manager decide whether technology is good now or finance or real estate or whatever. And I think that's done for us. So similarly, I think when you look at the retirement category, I think my aspiration, one, the category is small, as you said, funds that typically launch with anywhere between 75 crores to 200 crores or so. Some large fund houses have been able to, who have a lot of distribution backing behind them of their own banks or whatever, have managed to do rather well during launch. But I'm not thinking so much about that number right now. I do think that we will be in the same ballpark of 100, 200 crores of money that we may launch. But 15 days and, trying to focus on that is not what we want to do, which is why we've not really, you would have not seen us, banging our drums around an NFO. I think it's a journey. And if you ask me what I aspire for, is exactly like what we did in the international fund space. If there are going to be 25 funds in this category, I'm going to be in the top 5 in the next 3 or 4 years. And that's how I want to try and build this product with distribution. And I think that's because we also have a lot of relevant content and tools, both for customers as well as advisors when it comes to this subject. So there will be that attention, and I hope to get a positive rub off on the brand and the product for that.
Awesome. Awesome. I'm done with everything that I had to ask you, Rajat. I'm glad that we could have this discussed. While we have not spoken much on the fund, I think it's the intent in terms of why we're looking at this segment and the need of the hour in something called retirement. Now, obviously, because of what we do, at least in my practice, in terms of having weightage given to all these important goals, because first thing, a goal that gets a little more priority than the retirement is an emergency fund, obviously, so that you don't lose your peace of mind when it comes to if the inevitable were to happen. Sure. But after that, if there is anything that is more important, is retirement. And we've been looking at various alternatives. So I'm glad that we got this different perspective from you. And if there's anything that you'd like to tell to the audience that's going to be listening to this, I'd love to, and then we'll call it a day.
No, thanks, Shad. I think it's been a great discussion. I think we hit a lot of the important points. I think that I'd only conclude to say that, I think people need to have a picture of their life, in terms of what they see themselves doing. And if you want some direction about what picture you need to have in your life, I think the only thing you need to focus on is how active are you going to be? Because, forget the money. Health is true wealth, right? So how active are you going to be? And whatever research that we see around retirement, I think a lot of the problems related to this is this sort of cliff that you fall off after you stop working. Even if you're one who decides to stop working early, you want to travel, you want to stop at 35 or 45. A lot of young people want to do that. The point is you fall off a cliff on your health as a higher probability because you're not being active and purposeful. I think purposeful is
fulfillment.
So
that's right.
When you think about your future, I think it's great to do this visual exercise of saying, what purpose is it that I'm going to be occupied for the rest of the life? What do I love? What do I enjoy? What do I want to look forward getting up to? And for all you care, it could be that you want to support a cause or work with an NGO, and that still keeps you mentally and physically active. Money we can solve for in various different ways. There are strategies to get your money, and that's where having a gig income can potentially increase your ability to have that lifestyle as much as you want to, not be dependent on your kids and things like that. So the mental, physical aspects of retirement and the joy that you need to find as purpose, sort of thinking of it as your financial freedom goal. I think those are very important, sort of aspects on this subject. And to think that, equity and very safe equities, even if it was just a large cap fund and blue chip stocks that you wanted to, you got to make space for that in your portfolio, whether you're planning for it if you're younger and you can make larger space for it. But it doesn't mean that by the time you hit your 50s and 60s, you've got to bring that down to zero or something like that. You need to make sure that you have a good proportion of equity because that truly gives you the ability to beat inflation. It gives you the ability to keep your lifestyle going as well because you get those extra bonuses.
And given all the good prospects that the country has for the next 10, 15 years.
And you can just be in a good, diversified. I mean, you can probably move from small cap and mid cap funds that you've been saving for retirement in your younger years towards a diversified fund in your later years or a large cap fund in your later years. That's all the shift that you need to do. Not get completely out of equity. And so, the key is that the risk adjusted return that you need is important so that you don't have anxiety looking at your portfolio. And if you put that decision away and delay that decision, the risk is that as human beings, our sensitivity to volatility will make us do crazy things if you're planning for this a little late. So
Right.
enjoy the process.
All right, Ajit, thank you so much for taking the time out again, and all the best for the NFO. And
Thank you, Sharad.
hopefully, lovely things to hear from this again. Have a
Thank you.
nice
Look
one.
forward to more
Take care.
conversations. Thank you. Bye-bye.
Thanks. Thanks. Bye bye.